The cash rate has gone up to 4.1%. That's a quarter of a percentage point increase. And for those who are paying a mortgage, they are going to see their monthly repayments increase. If you have a $500,000 mortgage and you are holding that over 25 years, you will see a $76 monthly increase in your repayments. The total increase for the 12 now interest rate increases for a $500,000 mortgage, $1,134 a month. Now, of course, if you are in a big capital city and you have $1 million mortgage, which many people do, that would be $152 per month increase for this rate rise, the 12th from the RBA this cycle, taking the cash rate to taking the repayments rather to $2,269 per month extra since this rate hiking cycle began last May, when the cash rate was only 0.1%. Now, I am joined by Adelaide Timbrell, the senior economist at ANZ. Adelaide, you were in the camp that was broadly expecting an increase today. What's your reaction?
Yes, it was as expected, and we think this is likely not to be the last increase as well. So what we saw in the Reserve Bank statement, which they released with their monetary policy decision, they said some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. I think they are getting a little bit more concerned about the upside risks to inflation. Elsewhere in their statement today, they did note that the upside risks of inflation have grown. So what that means is their forecast is that by mid-2025, inflation's back to normal. But the risk that inflation's too high, even at that point, has grown compared to when they last met. We know this through the monthly CPI indicator, which shows that inflation actually accelerated in the month of April. And we also know that there's some real concerns around the cost of an hour of work. And that's not necessarily because wages are going up very quickly. They are going up 3.7% year on year, which is a decade high, but still relatively sluggish in the grand scheme of things. It's a fact that productivity isn't really growing quick enough. So although the amount of money we're shelling out per hour of work isn't growing much, the amount of output also isn't growing. And that's going to be a real concern going forward for the Reserve Bank. Now, we get productivity growth accelerating, we don't have to work as hard to get inflation down. But if we don't see that, the Reserve Bank's going to have to create more economic pain and lift interest rates higher in order for inflation to come back into the band.
I don't want to get into a discussion about productivity now, but there doesn't seem to be a quick fix to productivity in Australia. Now, you say you expect more interest rate increases. The ANZ updated their forecast to have the cash rate topping out at 4.35%. Do you think it could go even higher than that? Deutsche Bank saying 4.6%.
Yeah, so 4.35% is our central scenario. So being an economist, you pick one number when you look at the future, but we're not psychic. So our number generally represents the middle of a range of possibilities. So the fact that we're saying 4.35 means that we do think 4.6 is possible, just less likely than 4.35. I think, if we see productivity continue to be super sluggish, or if we see the super tight labour market being, lots of jobs and not a lot of workers to fill them, make wages go to an unstable place, which is probably a little bit less likely, then the scenario of a 4.6 cash rate becomes more of a central case. But for now, it's really more likely, from what we're seeing in the data, to be 4.35 at the top. I think the bad news for homeowners is that 4.35, once we get there, is not going to be going anywhere anytime soon. We actually don't think that there'll be any rate cuts until the very end of 2024. And that's because what we've seen overseas and what we've seen in previous cycles as well is that the type of inflation we have in Australia, it's not necessarily due to goods or imported inflation. It's not just global commodities, it's services on the ground. It's how much people are willing to spend, and we've really got to freak people out for a long time in order to change that attitude. That's nobody's fault, and certainly a lot of people are already feeling the squeeze, but enough people aren't feeling the squeeze, and enough people have sufficient savings that inflation is going to be a problem for some time, which means high interest rates will be an issue for some time as well.
Well, as you say, some people aren't feeling the squeeze, but some people certainly are. The RBA's own data says 15% of households are in negative cash flow right now. That was done in a calculation with a cash rate at 3.75%, so presumably more people will be in negative cash flow at a rate of 4.1%. I mean, it's fairly hard, I imagine, for those people who are in that situation to reconcile the fact that they have to feel the pain while others who perhaps own their home and have some savings there can still go out and spend.
Absolutely. There's a huge amount of inequality in both the economy right now and the impacts of those high interest rates. But what we have to remember is that inflation hurts all of us. No matter whether you own your home outright or paying off your mortgage or a renter, every single month that inflation is too high, the power of your paycheck gets deteriorated. And that's something that actually will stick with us and have longer lingering impacts than a temporary increase in those mortgage payments.
Well, the credit ratings agency S&P Global says mortgage arrears are rising, but as we know, so are home prices in most capital cities due to low stock levels. It's a pretty tough balance for the RBA.
It's a really, really tough balance. We saw that home prices actually went up by 1.2% in May alone and are rebounding quite quickly after a 9% decrease through the second half of 2022 and early this year. Now, one thing that says is that there are actually enough people around to drive those prices up, people who either have bigger deposits from a period of saving through COVID, and there are people who can, still borrow, significant amount of money. But it's also telling us that when we look more broadly at the data, there's not enough buildings getting built at the rate that we need them to be. There's a huge amount of population growth coming in this year. The average person needs more space than they used to because of work from home and other kind of post-COVID lifestyle changes. And all of this together is creating a huge housing shortage. This hits renters through low vacancy rates and rising rents. It hits homeowners through seeing higher prices if they do want to get into the market. And, I think when we look forward, this housing issue is not going to sort itself out in 12 months. This is going to be something we're dealing with to some extent for a couple of years, because for developers, when they're looking at the higher cost of funding, they're going, well, it's actually more expensive for me to build something. It may be too expensive to take that risk right now, even though home prices are going up and there's lots and lots of people who need them. So we are going to be continuing to see some economic pain through housing costs, and that actually hits directly into inflation as well.